Welcome to Iron Financial. Our job here is pretty simple. We help you forge a stronger portfolio. And we do that by cutting right through all the market noise and focusing on what actually matters, fundamental strength. Today, we are putting on the hard hats. We're going to go inspect a company that has the market completely, and I mean completely, baffled. ServiceNow. They just dropped an earnings report that, when you look at it on paper, looks like it's built from solid steel. But the market reacted like it found a massive crack in the foundation. So that's what we're here to do. We're going to stress test the numbers, we're going to inspect the framework, and we're going to figure out if this thing is a skyscraper in the making or just a house of cards waiting to fall.
Okay, let's start right here with the architect's vision. The CEO, Bill McDermott, comes out swinging with this statement of just absolute, unshakable confidence. I mean, listen to this. He's not just hinting that they're doing well, he's flat out claiming they are the best-positioned AI company for profitable growth in the entire enterprise space. And he mentions this Rule of 55+ profile. Now, for those of you who don't know, that's a benchmark that combines your growth rate and your profit margin. Hitting 55 is elite territory. So this is the bull case. Laid out for everyone to see, this is the blueprint for a financial fortress.
Hold on a second, analyst. A fortress? It looks more like the market brought in a demolition crew. I mean, just look at this disconnect. It's insane. The results are on the left. They beat expectations. They posted 21% subscription revenue growth, which is a huge number in this economy. They issue what they call exceptional guidance. And what happens? The stock gets absolutely hammered. It drops 11% right after the announcement and is down a staggering 50% over the last year. And yeah, sure, the whole neighborhood is struggling. You can see Salesforce and Adobe are down too. But my question is, how does a company fire on all cylinders and still see its value just completely collapse? That is the paradox we have to solve today. Is the market seeing a crack that we're not, or is it just totally blind to the strength that's right in front of its face?
That is the billion-dollar question. And to get to the bottom of it, we need a plan. So here's how we're going to tackle this step by step. First, we're going to really define this paradox that you just laid out so well. Second, we're going to do what we do best here at Iron Financial. We're going to forge the financials. We're going deep into the numbers, the absolute core structure of this company. Third, we'll take a hard look at the AI growth engine that they claim they're building. And we need to know if it's real or if it's just a bunch of hype. Exactly. Fourth, and this is crucial, we're going to address the market's biggest fears. We're going to look for those cracks in the valuation. And then finally, we'll wrap it all up and deliver the Iron Financial verdict. Is ServiceNow a structural opportunity or is it a very dangerous trap?
So, let's just frame this one more time before we really start digging in. On one side, you have the company's execution, which is, by all accounts, stellar, powerful. They are building a bigger, stronger business quarter after quarter. And on the other side, you have this punishing market reaction that is pricing this company not for success, but for failure. Strong steel, weak market. That's the conflict right there. Now let's get to work.
All right, it's time to put on the noise-canceling headphones. We're going to ignore all the screaming traders on the floor for a bit. Because right now, the only thing that matters are the raw materials, the hard numbers themselves. We are going to inspect the financial bedrock of this company, piece by piece, to see if it's actually solid enough to support that grand vision the CEO laid out. Let's start by looking at the load-bearing columns.
Okay, first up, the main pillar. Just trying to get your head around this number. Nearly $3.5 billion in subscription revenue for a single quarter. This isn't just a big, flashy number. This is the absolute lifeblood of the entire business. This is recurring, predictable cash flow coming from contracts that are already locked in. You know, in construction terms, this is the guaranteed funding that pays for all the steel, all the concrete, and all the labor before you even break ground on a project. A number this big provides an immense foundational stability.
But look, a massive base is one thing. What's absolutely critical here is the velocity. That huge revenue base isn't just sitting there. It's growing at 21% year over year. Think about that. In a macroeconomic environment where companies everywhere are tightening their belts, slashing their budgets, growing your core business by over a fifth is a sign of incredible structural integrity. It tells you their platform isn't just a nice-to-have. No, it's mission critical. It's the digital plumbing that these massive companies simply cannot afford to rip out.
But here's the kicker. Growth at any cost, well, that's a weak foundation. And this is where ServiceNow really flexes its muscle. A 31% non-GAAP operating margin. Let's be crystal clear about what this means. For every single dollar that comes in the door, nearly a third of it is pure operating profit. They aren't just building bigger, they are building smarter and way more efficiently. This isn't some high-growth tech company that's just burning through cash to stay alive. No, this is a well-oiled machine that prints money, which is absolutely critical for durability and for creating long-term shareholder value. So this puts the whole financial picture together. Just look at the consistency here. Subscription revenue, up 21%. Total revenue, right there with it. The operating margin isn't just high at 31%, it actually expanded by 1.5 points. And then you see that free cash flow margin, 57%. That is a massive, massive jump of 9.5 points year over year. This company is a cash-generating behemoth. But there's one metric on this screen that might just be the most important signal of them all, cRPO.
Okay, analyst, hold on. cRPO. You just throw out some Wall Street jargon that makes regular investors' eyes glaze over. So for the people at home trying to build a real portfolio, what does this actually mean? Is this just some kind of financial engineering, or is it real? It is as real as it gets. Look, simply put, cRPO is the backlog. It is the total value of all the contracts they've already signed that they will bill for over the next 12 months. This isn't a forecast. It's not a guess. It is revenue that is already locked in. It's the steel that's already been delivered to the construction site, just sitting there waiting to be put up. It is the single best indicator of near-term strength you can find.
And just look at the scale of that backlog, almost 13 times billion dollars. But even more critically, that backlog grew by 25% year over year. Now here's the key. That's faster than their current revenue growth. What does that tell you? It tells you that new business is accelerating. They are signing deals faster than they are recognizing the revenue from old deals. So the crucial takeaway here is this is not a company that's about to hit a wall. The pipeline for future construction is actually bigger and growing faster than ever before. The foundation for the next year is already poured and cured.
And who's funding all this construction? Well, it's their biggest and best customers. Just look at this chart. The number of clients spending over $5 million a year with them has jumped from 420 to 603 in just 2 years. That is a massive increase. These aren't small companies just experimenting with some new software. No, these are global enterprises making huge, long-term commitments. They're not just renewing their contracts, they're expanding them, building more and more of their core operations on top of the ServiceNow platform. This is the very definition of a sticky, indispensable platform.
Okay, so the financials check out. The core structure is made of reinforced steel, high-grade concrete. It's solid. But a strong building is pretty useless if it's not wired for the future, right? So now we need to look at the power grid. And for ServiceNow, and frankly for every other enterprise company right now, that means one thing: artificial intelligence. So let's see if their AI strategy is a robust new power plant, or if it's just a few extension cords plugged into the wall.
Now you have to pay attention to how they're approaching AI. This is the key differentiator. They're not just selling some shiny new AI tool as a separate bolt-on. That's what everyone else is doing. Their strategy is to embed AI directly into the existing workflows that people are already using every single day. They're positioning their entire platform as the AI control tower, basically a central nervous system for a business that spans IT, HR, customer service, you name it. It's designed to make AI a seamless, ubiquitous utility, just like electricity, while at the same time leveraging all the tech a company has already paid for. It's an integration play, not a replacement play, and that's a huge difference.
Okay, that all sounds great on a PowerPoint slide, analyst. It's a really nice sales pitch. But is it just marketing hype, or is this real? I mean, are customers actually buying into this vision? They are, and you don't have to just take my word for it. This quote right here from the Futurum Group adds that critical third-party perspective. They're seeing the evidence on the ground. Companies are moving past these small AI experiments and are now rolling out standardized platform-wide deployments. They're signing real checks. This isn't about pilots anymore. This is about production. It's about ROI.
And if you want the hard proof, there it is, the number that cuts right through all the noise. Their AI product suite, which is called Now Assist, has already surpassed $600 million in annual contract value. That is a massive number for what's essentially a brand new product line. But more importantly, the report says the net new ACV for this product more than doubled year over year in the fourth quarter. This is the clearest evidence you can possibly find that the AI engine isn't just sputtering to life. It's firing up and it's accelerating. Customers are not just kicking the tires here, they are buying the whole car.
And they aren't just building this in-house. They're making really smart strategic acquisitions to fortify their position. These aren't random purchases. They are buying the essential components they need to build out that secure AI control tower we talked about. Moveworks gives them a best-in-class AI interface for employees. The pending deals for Armis and Veza, that's all about security and governance. Armis gives you visibility into every single device on your network, and Veza manages who, and more importantly, what AI agents can access what data. So the crucial point is this: they are building a deep moat around their AI platform, and they're focusing on the #1 concern for every enterprise out there: security.
All right, analyst, I get it. I hear you. The building is solid, the financials are a fortress, the AI-powered grid is coming online, I get it. But a fortress built on an earthquake fault line is still a bad investment. You've shown me all the steel, but now I need to understand the ground it's built on. Because the market is terrified of something, and it's our job to figure out exactly what that is. Let's talk about the valuation and the narrative that is absolutely crushing this stock.
You know, the biggest ghost haunting the market right now is this idea of the death of SaaS. The story goes that in an AI-first world, all these traditional software-as-a-service companies are basically becoming obsolete. The old way of just selling software subscriptions is seen as a legacy model. So investors are demanding that these companies prove their value all over again. And until they do, the attitude is sell first, ask questions later. The fear is that ServiceNow, for all of its fundamental strength, is still, at its core, a SaaS company, and that entire category is at risk.
And this quote right here, this nails the specific fear. It's all about the price. When your stock has a high price-to-earnings ratio, it means you are priced for perfection. There is zero room for error, any hint of a slowdown, any whisper of a problem, and the floor just gives out from under you. Investors are looking at ServiceNow's PE ratio, and they're saying, this stock is expensive. And that high price tag assumes flawless execution and massive future growth. That is a very heavy burden to carry, and it is a concern that just will not go away.
And this brings us to the final crack in the armor, the guidance. Now, you called it exceptional guidance earlier, analyst, and based on the numbers, projecting around 20% growth, it is strong. But here's the problem. For a stock with a premium valuation, strong isn't good enough. The market wanted spectacular. It wanted a massive beat and raise that would justify that high price. Instead, they got guidance that was only slightly ahead of what Wall Street was already expecting. Now, for a normal company, that's a win. But for a high-flying tech stock that's priced for perfection, slightly ahead is a major disappointment. It leaves no room for an upside surprise, and that's exactly why the sellers came out in force.
Okay, we've seen both sides of the coin. We have stress-tested the foundation, and you've examined all the fault lines that the market is clearly worried about. The numbers are as solid as rock, but the narrative is built on shaky ground. So now, it's time. It's time to weigh the evidence and deliver the verdict. Is the market's fear creating a rare opportunity to buy a best-in-class asset at a discount? Or is it a warning sign of a trap that we should all avoid?
You know, the entire debate really just comes down to what you see right here on this slide. The foundation, on the left, it's undeniable. You've got over 20% growth in revenue and, more importantly, in future committed revenue. Elite profitability with a 31% margin, a 98% renewal rate, which is practically unheard of, and an accelerating AI engine. But you cannot ignore that fault line on the right, analyst. That high PE ratio hangs over everything. The whole death of SaaS thing is a powerful, scary story, even if it might not be true. And in this market, guidance that's merely great instead of impossible gets punished, plain and simple.
You're right. Even the strongest building can be shaken by an earthquake of negative market sentiment. But sentiment is fleeting. Fundamentals are durable.
So here's the iron financial verdict. The market is focused on the noise. It is panicked by sector-wide narratives and short-term guidance psychology. It's treating a premium company like it's a broken business. But when we look at the core structure, the revenue, the profits, the backlog, the customer loyalty, and the accelerating AI adoption, we see a foundation of immense strength. The disconnect between operational reality and stock performance is exactly where opportunity is forged. The market's fear is creating a foundational opportunity for investors who have the discipline to look past the noise and focus on the steel. The question isn't just whether you build on sentiment or strength. The real question is this: 5 years from now, will the market look back at this moment as a crack in the foundation or the single best time it ever gave you to buy the whole skyscraper?